Hi everyone, welcome back to the channel. In today's video, we are going to understand three important accounting terms, that is capital expenditure, revenue expenditure and deferred revenue expenditure. These concepts are super easy and by the end of this video, you will be able to answer any exam questions related to this topic. Let's start with capital expenditure, also called as CapEx. This is the money company spends to buy or improve long-term assets. These assets will give benefits for more than 1 year. Think of things like machinery, vehicles, buildings, and computers. If a company buys a new machine today, it will give benefits for more than 1 year. That's why capital expenditure is always recorded as an asset in the balance sheet. Let's say, for example, when a company spends 5 lakh rupees to buy a new delivery van, that's a capital expenditure. That will help for transportation of materials, goods and products. So the second we have revenue expenditure. This is the money company spends on day-to-day business operations. These expenses give benefits only for the current year. It is not for a long-term asset. Examples included like salaries, electricity bills, raw materials, rent and also small repair works. Revenue expenditures are recorded in the profit and loss account because they keep the businesses running smoothly. Simply, we can see the example like paying 25,000 electricity bill every month is a revenue expenditure. Third one is the deferred revenue expenditure. Now let's talk about deferred revenue expenditure. This one confuses many students, but it's actually very simple. These are expenses that are revenue in nature, but their benefit lasts for several years. So instead of showing the full amount as an expense in 1 year, the amount is spread over 2 to 3 years. Examples included for the deferred revenue expenditure is a big advertising campaign for brand launch. Second is a major repair work that gives long-term benefits. Third one is the preliminary expense when starting a company. Deferred expenses are first shown as an asset and then slowly written off over the years. Let's see a quick recap of the above terms. For example, capital expenditure. It is long-term benefit, creates assets. Revenue expenditure. It is a short-term benefit, runs day-to-day businesses. And the deferred revenue expenditure is the revenue expense whose business lasts multiple years written off slowly. Thanks for watching this video. If you found this video helpful, don't forget to like, share and subscribe. Comment below if you want more scripts for more accounting or business topics. See you in the next video.